It's Brian Preston, the money guy.
Here's the third thing we saw really interesting this year, and it's people using too much of their house as an asset. They're counting on the value of their home too heavily when it comes to marking out and strategizing their overall financial plans.
Now, look, it's interesting. I mean, it is one of those things. I am old enough that I was here in the 70s and 80s when we had the last big inflation jump. But I didn't own a house. My parents owned a house. I used to think forever, because my parents, I remembered in 1978, they built a house for $60,000. And I can remember when I graduated college and my portion of the rent, this is going to sound laughable because this is how old I am. It was like $450 a month was my portion. I had two roommates and my portion of the rent was $450 a month. Meanwhile, my parents' mortgage was like,
less than that.
It was like $300. So I mean, I remember thinking. I remember when my parents, a neighbor built a house in their neighborhood, and they were like, they whispered it in whispered tones. Their mortgage is $1,000 a month. So it is so funny to me to live through this inflationary period because I do think a lot of people have had a huge run up. If you look at the chart, look at this hockey stick. Since 2000, you can see there's been a nice walk up the mountain with homes appreciating really kind of with inflation.
Yep.
But then you get to 2020 and you see it truly is a hockey stick where from 2020 to 2022, it's about a 41% increase. So that obviously created a lot of opportunity for people to feel really fat and happy with how wealthy they are based upon their house appreciated. And Bo, we even found some research that showed a lot of people did cash out refinances.
That's exactly right. What's really, really interesting is if you look in 2021, out of $2.7 trillion worth of refinances, $1.2 trillion of those were cash out refinance. That's the most that we've seen since 2005. Because remember what happens is when we have a levered asset, it's not really our money, it's borrowed money, but then all of a sudden the price increases overnight 41%, and it's like we won the lottery. All of a sudden we have access to capital that we've never had access to before. So people start thinking, oh man, you know what I can do? I can now do a cash out refinance and I can go put in that pool, or I can go buy that secondary residence, or I can go upgrade those automobiles. And we have seen this happen over and over and over again. And people are making some questionable decisions in how they're using that home equity.
Well, I think it's interesting in the fact that, first of all, your house, that your personal, your primary residence is a use asset.
Yep.
This is something that it's the shelter for your family. It's the security for your family. But I'm not mad at those people that did the cash out refinance, because right now they're probably feeling really good because they went and took a mortgage at 2.5% to 3.5%, and they were able to pull that money out. So maybe it worked out well for them. But for all of you that are sitting on this 41% more of home equity, the good days, the time is probably, the buzzer has rung, and the fact that interest rates now are over 7% on mortgages. You're not going to go be able to do that cash out refinance like your neighbors did this in the same way. So you need to make sure that you're not looking at your annual net worth statement and feeling all frothy and happy with yourself and your net worth when it's something you can't even get access to without selling the house. And in this market, that's actually a harder thing to do because you have to move to a new community maybe you can get into a reverse situation where maybe there is a lower cost of living, but that's going to require you to move and sell, and that's a hard pill to swallow.
Yeah, what's really interesting, Brian, you mentioned how mortgage rates have risen, how they've climbed. Right now, this present moment, refinancing is at a 22-year low because rates have moved up. Here's what we're nervous about. It does not seem as though home prices are declining rapidly. Now, they may be declining in some unique markets, but a lot of folks still have a substantial amount of home equity. What we're concerned over is right now, 7% sounds like a really high mortgage rate. But as time moves on, even if mortgage rates settle down, you're going to start thinking to yourself, man, okay, yeah, you know what? I've got my low 2.5% mortgage, but maybe I can go get that home equity line. Maybe I can go take out that line of credit. And yeah, 5% is higher than it was, but man, I've got that equity I can tap. Be careful using your use asset to go expand the rest of your life. You don't want to take on more debt to increase your lifestyle simply because you can. Just because it's there does not mean it's something that you should use.
Well, and I want to give a cautionary tale on mindset too, is I think a lot of people with this big run up, I don't want you to change your behavior or just to slow down your desire to save and invest, because I'm worried that
I'm rich now.
Yeah, a lot of people are going to look at their annual net worth statement. They had that huge 40% run up on levered assets, so it's multiplied. It has an exponential factor, and you feel like, hey, maybe I don't need to go max out my 401k. Maybe I don't need to go fund the Roth IRA because look, I got $1 million sitting over here in my house. That might be a little bit of a mirage in the fact that, remember, you have to sell that use asset to get actual access to be able to retire or use that money. So I don't want you to have some false sense of security where you slow down the behavior of true wealth building, which is saving and investing, turning a little bit of what you can actually earn into net worth, because that is a big part, that discipline of living on less than you make, investing that through a disciplined life, and actually building wealth that works for you while you can sleep, while you do vacation. Your money's going to work harder for you than you do with your back, your brains, and your hands, and you don't have to sell the house.